$1,000 in your account. You don't touch it. A year passes, they're still there. And yet, you've lost money. How is that possible? Simple. Prices have gone up. What you bought last year costs more today. Your $1,000, they buy less, much less. And that nobody tells you. This phenomenon has a name: inflation, the general rise in prices. And here's the trap. You don't see it. Nobody sends you a bill, but every month, every year, your money sitting idle weakens. The scariest part? With 3% inflation, your savings lose a third of their value in 10 years. A third. Gone. And now, the good news. When you invest, your money generates gains. These gains stay invested, and they in turn produce new gains. That's compound interest. The more time passes, the faster it accelerates. Your capital becomes a machine. It grows on its own, without any effort on your part. Let's take a concrete example. $1,000 per month, 10% annual return. After 6 years, $110,000. But wait, half of this amount comes solely from interest. Half. Your money has literally doubled the effect of your savings. Remember that.
Do you remember BlackBerry? In 2008, everyone wanted one. The stock? $160. Investors were convinced it can only go up. Except 10 years later, it's worth less than $11. More than 90% losses. Past success never protects from the future. Never. Another example, even more striking. Kodak dominated global photography. Its stock, $100 in the 90s. Today, barely $1. They missed the digital revolution. Loyal investors who held on to their shares, they lost everything. Everything. Past performance guarantees absolutely nothing. An index fund? It's very simple. One single purchase, and inside, hundreds of companies. Apple, Nestle, Toyota, all united in one transaction. No more guessing who will win. You automatically own the winners and the losers. The result? The average market performance, without the headache. Warren Buffett, the most famous investor in the world, he built his fortune by picking stocks one by one. And yet, his advice for you and me? Index funds. Why? Because even the pros can't beat the market over the long term. So you might as well own the entire market at once. First criterion, the most important one, annual fees. Your limit? 0.5%. Maximum. Beyond that, you're paying too much for an automated service. The best ETFs on major indices? Around 0.2%. That's what you're aiming for. No more. Why this obsession with fees? Let's do the math. $10,000 invested, 1% in fees. That's $100 per year. Every year, without exception. $100 no longer working for you. Over 20 years, thousands of dollars gone. Small percentages have enormous consequences. Never forget that. Stop. Before investing, a question. Do you have high interest debt? A revolving credit at 25%? Paying off this debt is 25% return. Guaranteed. No investment rivals that. The rule is crystal clear. Eliminate expensive debt first. Invest afterwards. Second question. Do you have an emergency fund? Money available immediately, in case of trouble. You must cover 3 to 6 months of expenses. Without this safety net, you risk selling your investments at the worst time. Keep this money in a regular savings account, not invested. It's your lifeline. Good news! You can start with $1, just one. The starting amount? It matters little. What really counts? Getting started. Even $10 a month can grow over time. The habit of investing regularly matters infinitely more than the initial sum. So start now. But be careful. Golden rule to engrave in your mind. Only invest money you won't need for several years. Why?
Markets go up and down in the short term. If you have to withdraw during a downturn, you lose. Always keep a separate emergency fund. Always. Opening an account with an online broker? 5 minutes. You fill out a form, you send an ID document, the broker verifies. A few days later, it's validated. You transfer money from your bank, and there you go. Within a week maximum, you're ready to buy your first ETF. 2 main options. First, the standard brokerage account. Total flexibility. You withdraw whenever you want. Then, tax-advantaged retirement accounts like 401k or IRA. Tax benefits, less taxes, but with constraints. To start, many choose the standard account. Simplicity helps build the habit. The most important thing is to start.
2008. You invested $170 in a global fund. The crisis hits. Your investment plummets to $80. Panic sets in. But here's the secret. You haven't lost anything until you've sold. Those who held on, their $80 climbed back to over $550. Patience multiplied their stake by 4. A fact that will surprise you. Miss only the 10 best days in the stock market over 20 years, your returns cut in half. And these days often come right after the worst stops. By selling during a crisis, you miss the recovery. Panic costs you exactly what you're trying to protect. Ironic, right? The most effective strategy? Disarmingly simple. Same amount every month, no matter what the market does. This consistency eliminates the stress of choosing the right moment. You sometimes buy high, sometimes low. Over time, your average price balances out. It's mechanical, without emotion, and it works. Look at market history over 50 years. Every major crisis, a tiny ripple on an upward trending chart. Investors who held their positions through the worst moments all recovered their money, and much more. Time transforms crashes into anecdotes, into distant memories, without importance.